In October 2025, something extraordinary happened in the London silver market. Lease rates, the cost to borrow physical silver for short positions, spiked to over 33%. Under normal conditions, those rates hover near zero. 1 month, they're at 0.5%. The next month, they're at 33%. That's not a market functioning normally. That's a market screaming that physical metal has disappeared. And here's what nobody's telling you. This wasn't a one-day anomaly. This was the moment, the paper silver market, the system of futures contracts and derivatives that's controlled silver pricing for decades, finally ran into a problem it can't solve. Not enough physical metal to deliver. For years, silver has traded in two parallel universes. The paper market, where billions of ounces trade daily on exchanges like COMEX and the LBMA, and the physical market, where actual bars change hands. For decades, these two markets existed in uneasy harmony. The paper price, set by futures contracts, determined what you paid for physical silver. But in 2024 and 2025, that connection broke. Premiums on physical silver, the amount buyers pay above the paper spot price, exploded. Silver coins that normally trade $3 to $4 over spot were suddenly commanding $9 to $12 over spot. In some cases, physical silver was trading at nearly double the paper price. Dealers in India and China reported shelves empty, not because demand was crazy, because there's no metal to sell. Even when buyers offered premiums, they couldn't get it. And refineries across multiple continents reported unprecedented backlogs despite increased scrap flows. They're not running out of raw material. They're running out of capacity to process it fast enough to meet demand. This is the story of how the paper silver market, built on leverage ratios that would make a subprime mortgage broker blush, is finally facing its reckoning. How industrial demand from solar panels and electric vehicles is consuming metal faster than mines can produce it. How exchange inventories have fallen from 290 million ounces to below 210 million ounces in less than 2 years. And why the moment Wall Street can't deliver physical silver anymore is not coming in the distant future. It's happening right now. Let me show you exactly how the paper silver system works, why it's fracturing, and what happens when 350 paper claims try to squeeze through a door built for 1 physical ounce. Start with the structure. The silver futures market operates on a simple premise. Most contracts never result in physical delivery. Throughout the history of COMEX, fewer than 2% of futures contracts have ever been settled with actual metal. The other 98% get rolled forward to the next contract month or settled in cash. The system works beautifully when everyone agrees to keep playing the game. Traders buy and sell contracts. Prices move. Positions get closed. Cash changes hands. No metal required. But the system depends on one critical assumption, that physical demand will remain low enough that the small percentage who do want delivery can actually get it, and that assumption is breaking. Here's the scale of the problem. Daily trading volume in paper silver markets far exceeds annual mine production. Approximately 240 billion ounces of paper silver trade annually. Global mine production is roughly 830 million ounces per year. That means the paper market trades 290 times more silver than actually gets pulled out of the ground. Some analysts put the paper to physical ratio at 350 to 1. For every ounce of physical silver available for delivery, there are 350 paper claims on it. This isn't new. Leverage has always existed in commodity markets. But what's different now is that the players holding those paper contracts are increasingly demanding physical delivery, and the system wasn't built for that. In 2024, something changed. COMEX silver deliveries hit levels not seen in decades. In December 2024, 9,166 contracts stood for delivery. And here's where it gets interesting. The more metal that leaves the COMEX system, the harder it is to get back in. When physical silver exits COMEX warehouses, it requires complete reassaying before it can return. Every bar must be cataloged by purity, serial number, and weight. This creates massive friction. Metal that leaves likely doesn't come back. It's a one-way flow. Between March 10th and March 27th, 2025, 14 business days, the CME Group reported 48.7 million ounces of silver received and posted to COMEX vaults. Over those same 14 days, only 6.6 million ounces were withdrawn. Net change, plus 42.1 million ounces in 2 weeks. The bullion banks managing those vaults weren't expecting delivery demand to ease. They were bracing for more. Now let's talk about why demand is surging. Silver isn't just a monetary metal anymore, it's the most electrically conductive element on Earth. And the global economy is electrifying everything. Solar panels, electric vehicles, 5G infrastructure, AI data centers, all of them depend on silver's unique properties. In 2024, industrial silver demand reached a record 680.5 million ounces. That's the 4th consecutive annual record. And 2025 is projected to exceed that. The photovoltaic solar sector alone consumed 200 million ounces in 2024. By 2030, that number could hit 300 million ounces annually. And it's not just volume, it's the technology shift. New TOPCon solar panels require 50% more silver per panel than traditional designs. These panels need silver on both the front and rear sides, not just the front. So even if solar installations grow modestly, silver demand per installation is spiking. Electric vehicles use 2 to 3 times more silver than internal combustion engine cars. An average gasoline car uses about 15 grams of silver. A battery electric vehicle uses 30 to 50 grams. With global EV production expected to exceed 20 million units in 2025, that's 600 metric tons of additional silver demand just from cars. And AI data centers, the infrastructure powering the artificial intelligence boom, require massive amounts of silver for power distribution, thermal management, and circuit boards. Every expansion of computing power is an expansion of silver demand. The result is a structural supply deficit. The silver market has been in deficit for 4 consecutive years. 2021, deficit. 2022, deficit. 2023, deficit. 2024, deficit. The cumulative shortfall from 2021 to 2025 is estimated at nearly 800 million ounces. That's 10 months of global mine production just gone, consumed, not replaced, and mine supply isn't keeping pace. In 2024, global silver production increased by less than 1%, reaching 819.7 million ounces. Sounds like a lot until you realize demand was 1.16 billion ounces. The gap is 340 million ounces. Where's that metal coming from? Above ground stockpiles, inventories, and ETF holdings, and those are running dry. COMEX registered silver, the metal actually available for delivery against futures contracts, has fallen dramatically. Exchange inventories that totaled 290 million ounces at the start of 2024 dropped below 210 million ounces by October 2025. That is a 27% decline in less than 2 years. And registered silver, the portion available for immediate delivery, is even lower. Some estimates put deliverable silver at around 185 million ounces globally. That's enough to cover about 6 weeks of demand. 6 weeks. The London Bullion Market Association, the hub of global silver trading, saw its silver holdings fall nearly 40% since 2021. This is the steepest decline on record. And London isn't just a storage facility. It's where the majority of over-the-counter physical silver transactions settle. When London runs low, the entire global system feels it. Now here's where the paper market disconnect becomes dangerous. The London silver market, the LBMA, is built on unallocated accounts. When you buy silver through the LBMA system, you don't own specific bars. You own a claim on a pool of silver. The system works as long as redemptions remain low. But recent analysis revealed something shocking. Estimated cash spot silver contracts standing in London total somewhere between 4 billion and 6 billion ounces. Total London vault holdings are 851 million ounces. That's a ratio of 5 to 1 at minimum, potentially 7 to 1. And those vault holdings have barely moved during 2024's record supply deficit. The silver sitting in London vaults is illiquid. It's not available for delivery. This creates a mathematical impossibility. If even a small percentage of contract holders demand physical delivery simultaneously, the system can't honor it. There's not enough metal. And the lease rate spike to 33% in October 2025 was the market's way of screaming that message. Lease rates represent the cost to borrow physical silver. Traders who are short silver, betting the price will fall, need to borrow metal to deliver if they're assigned. Under normal conditions, lease rates are negligible, a fraction of a percent. But in October 2025, lease rates hit 33% annualized. Some transactions exceeded 100% annually. That means if you wanted to borrow silver to cover a short position, you'd pay the equivalent of the metal's full value just in borrowing costs over 1 year. Why would rates spike like that? Because holders of physical metal suddenly have all the leverage. They know the shorts are desperate. They know there's not enough deliverable silver, so they charge whatever the market will bear. And the market, in this case, desperate short sellers, will pay almost anything to avoid default. This is the opposite of normal market conditions. In a functioning market, arbitrage should close price gaps. If London silver is trading at a premium to New York COMEX silver, traders should ship metal from New York to London, pocket the difference, and the prices converge. But in late 2024 and 2025, that didn't happen. The premium persisted. Why? Because shipping costs are trivial compared to the premiums, but the metal wasn't moving. Approximately $75,000 to fly 300,000 ounces internationally. That's 25 cents per ounce. Yet despite London paying massive premiums over New York, the arbitrage wasn't closing the gap. That tells you the problem isn't pricing, it's availability. And there's another factor making this worse: potential double counting. In September 2024, analysts raised concerns that 100 million ounces of silver held by the iShares Silver Trust, the ETF known as SLV, might also be counted as COMEX inventory. SLV stores its silver with JP Morgan Chase. If that same silver is also listed as available COMEX inventory, the actual physical supply is far lower than reported. This isn't confirmed, but the lack of transparency from ETF providers and exchanges raises serious questions. Now, let's talk about what happens when the system breaks, when Wall Street can't deliver. There are 3 possible scenarios. First scenario, forced cash settlement. COMEX and LBMA have mechanisms to settle contracts in cash rather than physical delivery during extreme conditions. If demand for physical metal overwhelms available inventory, exchanges can invoke force majeure clauses or impose cash settlements. This has precedent. In 2022, the London nickel market suspended trading and forced cash settlements after prices spiked 250% in 2 days. The exchange couldn't handle the delivery obligations at those price levels. They just closed the market and settled in cash. If this happens with silver, contract holders expecting physical delivery get paid in dollars instead. At what price? That's the question. If spot silver is $50 per ounce, but physical premiums are $15, do you get paid $50 or $65? Likely $50, the paper price. And the physical metal, if you can even find it, trades at $65 or higher in the actual market. This would formalize the 2-tier pricing, paper silver and physical silver as completely separate assets. Second scenario, price explosion. If exchanges don't force cash settlement, the alternative is prices rising until demand is destroyed or supply is found. How high? No one knows. But history offers clues. In 1980, silver hit $49.45 per ounce. Adjusted for inflation using CPI data, that's $183 per ounce in 2024 dollars. In 2011, silver peaked at $48.70. Adjusted for inflation, that's roughly $67 in 2024 purchasing power. As of late 2025, silver is trading above $50, which is a nominal all-time high, but still substantially below inflation-adjusted 1980 peaks. If the paper market breaks and physical silver truly decouples, some analysts project triple-digit prices, $100 per ounce, $150, maybe higher. These aren't wild guesses. They're based on the fundamental supply-demand imbalance. If 350 paper claims exist for every physical ounce, and even 5% of those claims demand delivery, where does the metal come from? It doesn't exist. So price rises until industrial users, investors, or someone backs away. That's how markets clear when supply is exhausted. Third scenario, the slow grind. This is what's actually happening. No single dramatic break, but a gradual tightening where physical premiums widen, delivery delays lengthen, and the paper market becomes increasingly irrelevant for anyone who actually needs metal. Industrial users start signing long-term supply agreements directly with miners, bypassing exchanges entirely. Investors shift to physical coins and bars, paying whatever premium necessary. And the paper market continues to function for financial speculators, but the prices it generates have less and less connection to the actual cost of acquiring metal. This third scenario is the most likely because it's already in motion. Dealers report delivery delays extending from days to weeks. Premiums on popular coins like Silver Eagles and Britannias have widened from 3 to 4 over spot to 9 to 12 over spot. Refineries are paying only half of spot value for scrapped silver because they can't process it fast enough, not because demand is weak. And lease rates, those 33% spikes, signal that physical tightness isn't temporary, it's structural. Here's what the industrial users are doing. They're securing supply. Companies that depend on silver for manufacturing, solar panel makers, electronics manufacturers, automotive suppliers, are shifting to long-term contracts with primary producers. They're bypassing the spot market entirely. They're locking in metal at fixed prices years in advance because they know the spot market can't reliably deliver what they need. This is how the paper market dies, not in a crash, but by becoming irrelevant. The paper price might say $50, but if you need metal for production, you're paying $65 on a long-term contract. If you're an investor buying physical coins, you're paying $62. The paper price becomes a fiction, a number that exists for financial settlement but has no connection to reality for anyone operating in the physical world. And the investors are waking up. Silver ETF inflows in the first half of 2025 reached 95 million ounces, pushing global holdings to 1.13 billion ounces. That's just 7% below the all-time peak. And importantly, some ETFs in India halted new share creation because they couldn't source enough physical metal to back new investments. When ETFs, the primary tool for financial investors to gain silver exposure, can't buy metal, that's a red flag. Now let's address the elephant in the room. If this supply deficit is so obvious, why isn't silver at $100 already? Why is the paper market still functioning? Because the system has enormous inertia. The big players, the bullion banks that manage these markets, have every incentive to keep the game going. They make money on volatility, on bid-ask spreads, on financing. A functioning futures market is profitable. A broken market is chaos. So they manage the pressure. They import metal when premiums get too high. They use their balance sheets to provide liquidity. They employ sophisticated spread trading to manage risk. And critically, they have regulatory protection. Exchanges can impose position limits, halt trading, or force cash settlement if things get out of hand. The system is designed to protect itself, not the individual traders who demand physical delivery. But there's a limit. The bullion banks can manage short-term stress. They can't manufacture silver out of thin air. And with each passing month, as mine supply grows by less than 1% while industrial demand grows by 7%, the math gets worse. The gap between supply and demand is widening, not closing. In inventories, the buffer that's absorbed the deficit for 4 years are running out. COMEX registered silver is now measured in weeks of demand, not months. London's float, the available metal not committed to industrial or financial obligations, has fallen to 185 million ounces, a 40% reduction from pre-2020 levels. And most revealing, the bullion banks themselves are reducing their short positions. In late 2024, swap dealers, that's the category that includes bullion banks, covered half their short positions in the COMEX silver market. They went from being short 212 million ounces to short 106 million ounces. They're exiting while they can. This is the smart money positioning for what's coming. They see the physical shortage. They see industrial demand that won't stop. They see inventories that can't last. And they're reducing exposure before the system breaks. Here's the timeline as it's unfolding. 2024 was the year physical tightness became visible. Premiums widened, lease rates spiked intermittently, and deliveries hit record levels. 2025 is the year the paper market begins separating from physical reality. The disconnect is no longer occasional, it's persistent. By 2026, if current trends continue, the question won't be whether the paper market can deliver. It will be whether the paper market still matters. And when that moment arrives, when Wall Street can't deliver anymore, it won't look like a crash. It will look like a market that just stopped working. Futures contracts will still trade. Prices will still update. But anyone who needs actual silver, for production, for investment, for delivery, will operate in a different market entirely. A market where physical premiums are $20, $30, $50 over spot. A market where delivery takes months, not days. A market where the paper price is a relic from a system that no longer reflects reality. The breaking point for silver isn't a single day, it's a process. And that process is well underway. 4 consecutive years of supply deficits, inventory drawdowns of 40%, lease rates hitting 33%, industrial demand at record highs and projected to keep growing, mine supply increasing less than 1% annually, and a paper market built on 350 to 1 leverage facing delivery demands it can't meet. This isn't speculation, this is the data. The silver market is under stress unprecedented in modern times, and the system that's controlled silver pricing for decades, the paper futures market, is facing a problem it's never had to solve. What happens when the metal runs out? The answer is already appearing in the premiums, the lease rates, the delivery delays, and the vault drawdowns. The paper market is becoming irrelevant for anyone who needs actual silver. And once that realization spreads, once industrial users, investors, and even ETFs fully understand that paper claims can't be reliably converted to metal, the repricing will be swift and severe. Silver's breaking point isn't coming, it's here. The only question is how long the paper market can pretend otherwise.